a major shift is underway in one of Wall Street's most watched investment funds, and the ripple effects could redefine where institutional capital flows in 2026. Billionaire investor David Tepper has slashed Appaloosa Management's portfolio by nearly $1 billion in the first quarter, a decisive move that signals deep strategic rethinking at a time of mounting economic pressure. The real story isn't just the scale of the reduction, but what it reveals about where Tepper now sees long-term value: digital platforms, semiconductor infrastructure, and consumer tech resilience. This isn't diversification, it's concentration with conviction. Regulatory filings with the SEC show that as of March 31, 2026, Appaloosa Management's total equity holdings now stand at just under $6 billion. The 13F filing, which details institutional equity positions, confirms a sweeping realignment under the David Tepper portfolio banner. What stands out is not merely what was sold, but how aggressively Tepper pivoted away from legacy sectors and doubled down on a select few high-conviction bets. The fund didn't just trim positions, it executed full exits, restructured allocations, and established new stakes in technology areas showing structural growth momentum. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Amazon emerged as the clear centerpiece of this new strategy. Tepper acquired an additional 2.1 million shares during Q1, boosting the fund's total stake in AMZN to a value of approximately $900 million. That single position now represents about 15% of the entire David Tepper portfolio, making Amazon the undisputed top holding. This isn't a speculative bet, it's a foundational allocation, reflecting confidence in Amazon's dual dominance in e-commerce and cloud computing at a time when digital infrastructure is increasingly seen as recession-resilient. But Amazon wasn't the only tech giant to gain favor. Uber saw one of the most dramatic increases in exposure. Appaloosa added 4.5 million shares, more than tripling its stake and bringing the total value of its Uber stock to $455 million. That positions Uber among the 5 largest holdings in the fund, underscoring David Tepper's growing appetite for scalable, asset-light, consumer-facing platforms. The important part isn't just the new bets, it's what had to be sold to make them possible. The David Tepper portfolio underwent a full sector purge in aviation. Appaloosa completely exited all airline positions, liquidating holdings in American, Delta, and United Airlines. The American Airlines stake alone was valued at $217 million at the end of 2025, making its total exit a significant reversal. The move wasn't isolated. It reflected broader concerns over fuel cost inflation and geopolitical instability, particularly amid ongoing tensions related to the Iran conflict, which have pressured airline profit margins and operational predictability. Meanwhile, in the tech sector, Appaloosa made sharp cuts beyond just aviation. Alibaba, once a major holding, was slashed from 5.1 billion shares to just 3.5 million, a reduction representing $318 million in market value. This Alibaba stock sale signals a clear retreat from Chinese e-commerce exposure, likely driven by regulatory uncertainty and slowing growth in the region. Microsoft also faced divestment, with 410,000 shares sold, leaving only a minimal 90,000 share position worth about $33 million. Yet even as some tech names were reduced, others were aggressively expanded. Micron Technology saw increased allocation, now commanding 9% of the portfolio, while Taiwan's semiconductor manufacturing company rose to 8%. Alphabet remains a core holding at roughly 8%, maintaining steady exposure to digital advertising and AI infrastructure. The fund also made a bold new move by establishing a $179 million position in SanDisk, purchasing 281,250 shares, betting on long-term demand for flash memory and data storage solutions amid the AI and cloud computing boom. The underlying mechanism here is not market timing, it's structural conviction. Tepper's strategy reflects a pivot from cyclical, asset-heavy industries to scalable, technology-driven platforms with global reach and pricing power. The David Tepper portfolio is no longer chasing broad diversification. Instead, it's concentrating capital where digital transformation is accelerating: cloud, semiconductors, mobility, and data infrastructure. Still, questions remain. While the moves signal confidence in certain sectors, they also increase concentration risk. What happens if Amazon's cloud growth slows? If Uber faces regulatory headwinds in key markets? Or if geopolitical tensions disrupt semiconductor supply chains? Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The takeaway is clear. David Tepper is placing high-conviction bets on the digital economy's backbone. The David is now more focused than ever, less exposure to airlines, reduced presence in China, and a powerful cluster of positions in Amazon, Uber, Micron, and Taiwan Semiconductor. For investors watching institutional trends, the message is loud. The future, at least in Tepper's view, runs on data, delivery, and digital infrastructure. The next signal to watch. Any changes in Appaloosa's filings later this year, especially if new pressure points emerge in fuel, trade, or tech regulation.